Good morning. Good morning to all. Welcome to another earnings call for SYGNUS Alternative Investments Limited. Today, we will be able to discuss and walk through the Q2 earnings as at December 31st, 2022. Our moderator today, or our presenter today, will be Jason Morris, Chief Investment Officer for SYGNUS Capital, the investment manager for SYGNUS Credit Investments Limited. So we're asking just for an additional 3 minutes, just allow for additional call to join, and then we'll begin the presentation. All right. So good morning again, everyone. My name is Hunter Richards, Investment Management Associate at SYGNUS Capital. The investment manager for SYGNUS Credit Investments Limited. Just some housekeeping. We will have a Q&A section toward the end of the presentation, which will invite all attendees to write their questions throughout the presentation, and we will have them addressed towards the end, as well as we'll also be open to, you can send emails to info@sygnusgroup.com if you have any additional questions after the presentation. This presentation will be uploaded to the sygnusgroup.com website, as well as the recording of this earnings call. So I now welcome you, Jason, to walk us through the Q2 results for SYGNUS Credit Investments.
Hi, good morning, everyone. Can you guys hear me?
Hearing you loud and clear.
Okay, great. Fantastic. Good morning, everyone. Welcome to another live earnings call for SCI. I have a few slides that I want to go through. It's a pretty boring quarter and 6-month period, so let's begin. First things first, the sum total of the earnings call does not represent all the information available to shareholders. You need to go and review the financial statements that were released to the Jamaica Stock Exchange, as well as a detailed management discussion and analysis that is accompanying those financial statements, which is something that we have done since the inception of releasing information on SCI as a publicly listed company. And you can find those information either by going to sygnusgroup.com or, as usual, to the Jamaica Stock Exchange website. Okay, so let's get into the next slide. So for the 6-month period, SCI, is showing a record for net profit. So record net profits, record total investment income, record net investment income. As you can see, net profit was 2.86 million, up 16% versus last year. Total investment income, which is our core revenues, came in at 4.53 million, up 22.7% versus last year. And net investment income, which is core earnings, was 2.65 million, up 16.2% versus last year. Earnings per share, 48 US cents, 0.48 US cents rather, versus 0.42 US cents last year. And the diluted earnings per share, because we do have a small amount of preference shares, was 0.47 US cents versus 0.42 US cents. The key here really is, as we would have highlighted at the annual general meeting in January, that we are focused on enhancing shareholder value over the medium term. The first 5 years of SCI were focused on preserving shareholder capital, trying to scale the business, get the business to a steady state from which we can scale it, and the scaling process has started. We should also highlight the fact that the board of directors will meet on February 21st to consider, and if deemed fit, perhaps approve a dividend to be paid, an interim dividend to be paid. So that is something that we'll, as usual, announce in due course. If we look at the quarter, we had a similar type of performance. So for the Q2, which is between October 1st to December 31. We also reported a pretty decent performance where net profit was 1.23 million, up 28.8%. That's our Q2 record. And total investment income or core revenue is 2.26 million, up 20.7%. And net investment income at 1.28 million, up 10.7%. And of course, earnings per share, 0.21 US cents versus 0.16. And diluted earnings per share, 0.20 versus 0.16 last year. Now, if we move to the next slide and look at the quarterly and 6-month core revenues and core earnings, which is total investment income, net investment income, you can see that by and large, SCI doesn't have a problem growing on the revenue side because we have been growing at a 55.4% compounded annual growth rate since we began operations in 2017 on the revenue side, and on the core earnings side, which is net investment income, that's going at 45.1%. So that's just to show you the information on a 6-month period, which is in the red, and sorry, the quarterly results, which is in the red, and the 6-month, which is in the blue color. Now, I want to spend a little bit of time just walking through what drove the financial results that we saw for the quarter and for the 6 months. So if you may happen, yeah. So, I think last quarter we went through this, but just in case there's anyone who's on the call for the first time, if you look at the quarterly results first, you can see that net interest income, right, is a bit lower this year than it was last year. And you will recognize that the main driver for that, even though interest income increased by a pretty decent amount, interest expense rose substantially. And the reason why interest expense would have risen from 603,000 to 1.4 million is primarily because we basically use 100% debt to finance the acquisition of Accent Financial Corporation in Puerto Rico. However, that company is not consolidated into SCI, right? Because we failed 2 of the 3 accounting rules that are required for consolidation. And so we have interest expense related to that transaction, but we don't have any interest income relating to the debt that we use to finance it. So the way you have to look at this is that, okay, so our net interest income is being kind of skewed to the downside, but we make up for that by what you call the Puerto Rico Credit Fund investment income, which is the net benefit that we derive from owning that asset, even though it's not consolidated, right? So if you look at total investment income, the key to look at there is not so much net interest income anymore. It's really to look at total investment income, which is including now the line called Puerto Rico Credit Fund investment income. And that would be pretty much the same thing that you would see for the 6-month period. And of course, a little bit after that you would have seen for the financial year in June. So you may have a question and say, okay, that's fine, but what interest rates have gone up? So what is the difference between kind of your spread that you're earning on your asset side versus your expense cost on the expense side? And that is pretty straightforward. I think the last quarter we were at like 5.9% or 6% thereabout, a weighted average cost of debt. That would have gone up by about 158 basis points because we rolled off the balance sheet, I think 33 million in December, and the average cost of the debt that we took off the balance sheet was, I think, 6.19%. The average cost of the debt that replaced the debt that we rolled off was, I think, 7.58%. So our interest expense went up by, call it 150 basis points. But on the asset side, of course, I think last year the portfolio would have been earning 12% or 12.1. I don't remember which one. I think I have a slide on that. I know we are earning about 14%. So, that's not hurting us too much at the moment. Is there anything else that I want to highlight here? There's nothing material that I want to highlight here. Of course, you can ask them, anything that you want to ask, any question and answer section. Next slide. So, efficiency and management expense. This is how you know whether or not we are managing the company properly. So 2 key metrics to always watch is, okay, what is our efficiency ratio? The standard that we have set ourselves, which is in tandem with global best practice, is to maintain that 40% and below threshold. For the Q2, at the end of the Q2 period, we were at 41.5%, a little bit over the threshold limit, but this was driven primarily by the fact that we had about $227,000 in what I want to call one-off expenses. Some of them being spillover from the year-end audit, and others which are one-off consulting fees that have to do with a number of different things that won't necessarily repeat on a go-forward basis. So we should see all our things being constant, the normalization of the efficiency ratio. And as I said before, if you look right across global firms that are in this business, and if you look in Jamaican market in particular, you don't have many financial firms that are anywhere close to 40% as an efficiency ratio. So that's a benchmark that we have set ourselves to show that we're not leaking out revenues that we generate in expenses. The second thing to look at is, what are operating expenses as a percentage of assets under management. This one is perhaps bigger than, more important than your efficiency ratio. We set a threshold limit of 2.85%, and we are well within that threshold. And so we continue to manage the company according to global best practice when it comes to expense management. The balance sheet, shareholders' equity, 68.8 million, up marginally. Total assets is now 153.6 million, up 39.2% versus last year. Of course, 25.4 million of this is going to be related to the asset, the investment that the 93.66% acquisition of Accrescent Financial Corporation, which we are referencing as Puerto Rico Credit Fund investment. In terms of balance sheet, key performance indicators that we're looking at are, generally speaking, debt to total assets. That's at 0.5 times, which is right on our limit. I need to highlight though that effectively this limit is a net debt limit. The ratio that we are showing here is actually total debt. We actually have 10 million cash on the balance sheet as at the reporting period. So in actuality, debt to total assets is probably 0.4 a little bit, right? Because that cash could actually be used to repay debt immediately. So at the moment, we are not in danger per se. Asset coverage ratio, we want that to be above 1.5 times. Again, it's a key metric for private credit investment companies, because by and large, private credit investment companies should only have financial assets on their balance sheet, which SCI does. 100% of the assets on the balance sheet are financial assets, which means we can convert those assets into cash. So the asset coverage ratio is just a ratio to say if we have coverage of more than 1.5 times, I could discount the entire balance sheet by 50%, for example, and sell those assets to repay my debt. So we always want to maintain this asset coverage ratio of at least 1.5 times. Debt to equity, 1.11 times on an adjusted basis. Again, this ratio is actually lower in reality because we did not subtract cash from the debt, and we have 10 million of cash sitting on the balance sheet. So the ratio is actually probably closer to 1 than 1.11. And then, the other thing is just looking at our credit rating to ensure that we all maintain or improve that as we go through time, because we are committed to shareholders that SCI would become a rated company and would remain a rated company for the remainder of its life, which is forever, in our view. And just to highlight the fact that we have a minimum threshold of a 500 basis point spread between the earning assets on the balance sheet versus the liability which is the debt financing, which we are above that threshold at the moment and intend to maintain that. So now, just moving into the portfolio activity for the period, investment in portfolio companies, 110.7 million. When you exclude the carrying value of the Puerto Rico Credit Fund and the balance sheet, if you include, and that is up 25.8%. If you include it, then you're talking about 136 million in private credit investment assets on the balance sheet, which is up 54.6% versus the same time last year. We now have 34 portfolio company investments versus 29 last year. We would have done 7.43 million in new investments during the quarter. For the 6-month period, I think that's 11 million. Fair value yield, as I said before, 14.1% versus 12.9%. So you can see that even though the interest expense for the debt that we would have refinanced at the end of the financial year would have gone up by about 150 basis points. And we're kind of resetting that with the overall portfolio yield. And that's one. And two, we obviously have other liabilities on the balance sheet that will remain. They are longer term liabilities that will remain at the below 6% average cost of debt. And obviously, all new assets that we are putting on the balance sheet is pretty much 14% and above. The tenor, pretty short, less than 2 years. In fact, we have a substantial portion of the assets are maturing within 12 months, right? So that means because we have a good portion of the portfolio maturing in under 12 months, that means that as those assets mature and we replace them with new assets, those new assets are going to obviously be at the new yield benchmark based on where the market is. I spoke about the almost 11 million that we have in dry powder sitting on the balance sheet, and we also have additional monies, capital that we are looking at. We are advancing in terms of raising. That's not included in this dry powder, and of course that includes revolving credit lines locally with one of our banking partners, and of course the main thing is some very large credit facilities that we are currently walking through the process of structuring with some international financing partners. And we're also in the process of talking to a few others to bolster that, because as we would have said at the annual general meeting, we are looking at least 100 million US, and that's now public knowledge, 100 million US in credit facilities as well as quasi debt. And that quasi debt is something that we will bring to the local market in due course during in another few months. But the international financing with those partners, we are looking for some big facilities with them. So that process is advancing and will continue, and we'll provide more information with you as we go through time. Our balance sheet is very, very big. I mean, we have 20 million in transactions going through different documentation at the moment and drawdown, and we have substantially more than 100 million in live transactions across the English and Dutch speaking Caribbean. And this does not include what SCI in Puerto Rico has on their plate chewing. So overall, the business has a phenomenal pipeline of opportunities. The key is to get the capital in to finance the opportunities. So in terms of SCI itself, just to give you some tidbits, the average private credit portfolio would have averaged about north of 50 million during the course of 2022 calendar year. Remember, SCI has a different financial year end from SCI at the moment. Of course, that will change once the integration is completed. So for the entire 2022 financial year, the average on balance sheet net earning assets would have been in excess of 50 million over the period. Of course, this just includes what they hold on the balance sheet, doesn't include the assets that they would have structured and sold off the balance sheet. which is also in excess of 50 million. I don't want to give them more specific information other than that for competitive reasons, obviously. New investment commitments during the December quarter would have been north of 20 million, which I believe would have been a December period record. So it would have been a record for a December period for them. And I think for the entire financial year for 2022, they would have also originated a record, a full calendar year record, which would have been north of 50 million as well for the financial, just for the financial year itself. And of course, as would have been saying from we did the acquisition, is that for Accusent, this includes true sales, which are assets that they sell on the balance sheet, as well as assets that they're holding on the balance sheet for net interest income. And of course, the yield is above 10.1%, and the tenor is just under 3 years, and all of this aligns perfectly with SCI, which is why SCI went and did the acquisition in the first place. In terms of risk management, non-performing investment ratio is now 1.5% versus 6.2% for the same time last year. Of course, if you recall, same time last year would have had Margaritaville Cayman, which would have been the asset that would have had the full charge off on at the end of the financial year, which in October the courts would have ruled for the company to be wound up. And we are still pursuing all options available to SCI to recover part or all of its capital. Of course, I would have stated from before that this is a long process, and from our point of view, we have taken the charge off. Any monies that gets returned to us, if any, we will happily take that, and we are pursuing all options. From our SCI portfolio allocation by industry point of view, these two charts are pretty messy. I think on a go-forward basis, we perhaps just start reporting the top 10 exposures, but it's a good problem to have. So from a SCI excluding the Puerto Rico Credit Fund point of view, which is the left chart on the left, we now have a record 13 industries, with the new industry being a facility that we would have invested in the transportation sector, which accounts for 2.1% of SCI's portfolio. And so financial services makes up 21.9%, construction 15%, manufacturing 13.3%, right? If you include the portfolio, the underlying portfolio of the Puerto Rican assets, then you're talking about 22 different industries. And now financial services is still the largest industry, but you see that it's 14% in terms of concentration. Hospitality 13.1% and construction 12.1%. So our threshold limit for industry exposure from the SCI only point of view is really 35%. And so we are nowhere close to those concentration limits, which is a good thing. On to the next slide, in terms of allocation by region, if you exclude the Puerto Rico asset on the balance sheet, you see that Jamaica is 40.3% of the asset on the balance sheet, the portfolio. And this is actually coming from some closer to 60% maybe a year ago. St. Lucia 16.8% and Bahamas 15.9%. If you include the Puerto Rican assets, then we're talking about 30.9% for Puerto Rico, 27.1% for Jamaica, 11.3% for St. Lucia. So the Puerto Rico figure, right, it will actually fluctuate a little bit, because recall that in Puerto Rico, the business model is they have assets on the balance sheet. They sometimes will sell off those assets aggressively and then use that cash to refinance new assets and book the gain up front, right? So when they do that, you can have periods when you're sitting in a bit of cash, and then that cash is going to be deployed, and then the next quarter or the next 2 quarters, you see the cash being deployed. And once the cash is being deployed, then it means that the portfolio value can increase in some instances dramatically. So then to the final slide, just to look at our strategy. So our strategy for the next 3 years is really about enhancing shareholder value. I would have discussed this at length at the AGM in January. But for those of you who weren't there, I weren't able to participate, I'll just briefly explain what our thinking is. So over the next 3 years, beginning obviously from December. The first thing is the acquisition in Puerto Rico to complete the integration. We are now we're in deep into phase 2 of the integration, which is far advanced. We expect to complete the integration before the end of the financial year. Ideally, we would like to time it right as the financial year ends, so that everything goes smoothly. We have already gone into the business and kind of rejigged how the business operates in terms of streamlining, how we execute and how we originate, and how the business lines are aligned with what we do in SYGNUS. And basically just adding our 2 cents to what was already a fantastic business with a fantastic team. So sharing of information, we have taken some of the principles that Puerto Rico has on board. They have been in operation for 19 years. So, there's a lot that we can take from them and we have taken from them. And there's also stuff that we do that we have shared with them. So that process has continued to unfold, and both businesses the overall business will benefit tremendously from that. And the key here is to scale the business to generate substantially more revenue and net profit. And I said before, the company actually had its best year ever in 2022, and its best fourth quarter ever in December quarter in 2022. So that's great. And our intention on a go forward basis is to let each of the next 3 years be the best year ever in terms of financial performance. So as we go through time, we'll get additional update on that. The second key thing is over SCI's overall growth path, right? And we would have highlighted these at the AGM. So basically, from December, what we want to do, we want to grow core revenue by at least 50%. So we need to get core revenues, our total investment income, to above 12.5 million. And we have already started that process, obviously. We also need to get our ROE in steady state to above 10%. Right now, I think we are probably 6% and MASH. We need to get to 10%. So in steady state, which, by 3 years, within 3 years, before the end of 3 years, our ROE, when you look at our financial performance, we need to be showing 10% ROE and above, minimum. We need to grow earnings per share by 75% relative to where we were. We ended the financial year, I think, I don't remember where we ended it at. But that EPS, I think it's 60 something cents. We need to grow that by a minimum of 75% and keep growing that on a go forward basis. The dividend yield, using the last time we did an equity offer, which is the APO, need to be minimum 5% in steady state. And we need to raise at least $100 million in credit facilities and quasi debt in under 12 months. And those negotiations, as we said before, are advancing. And we need to generate $300 million or more in origination. So we have already started on a good path. We are well north of $100 million already in terms of what our pipeline is, and just in terms of mandated transactions. I think we are probably done since the start of the financial year. More than in terms of mandates, we probably have that in the pipeline mandated. And so what we're trying to do is trying to push very hard to get the financing in to actually execute those mandates. So you'll see a lot of movement on that in coming weeks and months in the market. And then new revenue streams to buttress net interest income. That's already in train, and we expect that will probably start showing up in the financial statements in a few in the short term. So that's our strategy for the growth part of the next 3 years. And then finally, share buyback, which we discussed in detail at the AGM. And of course, as soon as we discuss this and approve it at the board, it will be launched. Obviously, we won't be advertising to tell the people that we are going to buy back the shares on like February 17, we won't do that because we don't want front running. But when it's approved, obviously we need to notify the stock exchange, and then we just execute. Ultimately, this is to actually enhance shareholder value, and we think that the stock price has suffered for it does not reflect the reality of the company, and so that's one of the reasons why we're doing the share buyback, as well as just to provide liquidity, and the fact that we think that the shares are substantially overvalued based on where they were or where they have been trading on an average basis over the past year and a half. It's just crazy undervaluation. So we have said that this is going to be open market. We'll have obviously internally have like quarterly buyback target amounts, and we are going to do this for a 3-year, right? This will last for 3 years. So this is not a fly by night one time buyback and then we are done. We're going to consistently do this with an allocation, as we said before, anywhere between 1 and 3 million. And once that is done, it's done. So that is our strategy to enhance shareholder value. And we're going to be very diligent about this and push very hard. Obviously, we're in an economic environment where there are a lot of moving parts. Interest rates are rising. Inflation is high. But we're not really concerned about those things. The company has very low leverage, and it was built for environments just like these. Private credit companies actually thrive during bad market conditions. That's what that private credit actually started in a period in the US when there was a struggle for companies to access financing because the economies weren't doing well and banks and regular financing couldn't meet the need. So private credit exists to fill a particular gap in the market. And gaps normally exist in markets when there's financial pressure, right? Or financial dislocation. So we are right in our sweet spot. What I would say, generally speaking, though, is that we have a large allocation to Jamaica. And our view on Jamaica is that the most important thing is that the debt ratio is trending down. We expect Jamaica to get upgraded over the next 3 years of our strategy that we have here. And therefore, if Jamaica debt ratio is going down, below 80%, and we expect the credit rating to improve, that means the long-term cost of debt for Jamaica will go down. It will absolutely plummet from where it is today. And when that happens, the economy will actually expand at a faster rate. And so we are willing to take that bet, and medium-sized firms that are in Jamaica to say, over this time horizon that SCI has for a strategy, they will come good and they will grow fast and they will expand and we will grow with them. And we are here to provide an alternative challenge to those firms. And we are taking the same approach to all of the other 7 Caribbean territories that we have exposure. And obviously, Puerto Rico is a $100 billion economy, and Puerto Rico has about $50 billion earmarked for spending over the next 5 years. And Puerto Rico is the gross national product. Forget the fact that the GDP of the economy is about 100 billion. The gross national product, which is what you can say the real value of the economy, is about 70 billion, right? But they have $50 billion earmarked in reconstruction and infrastructure spending. So it doesn't matter if the world economy goes through a slowdown or a recession, that 50 billion, which is pretty much equivalent, a substantial percentage of their gross national product, means that the Puerto Rican economy is going to thrive, in our view, over the next 5 years. And I'm just returning from Puerto Rico, having spent a week there. I return on Monday. And I can tell you that our 1 week sojourn, speaking to entrepreneurs, speaking with some of the businesses that are present in Puerto Rico, is actually have financed, speaking to entrepreneurs who have actually repaid us back our money. We are having lunch and dinner meetings with people who, we are celebrating the fact that we financed them, we facilitated, and they paid us back in due course. We got back all of our money plus our interest, and they are celebrating the fact that we really came in and filled that breach that the banks couldn't fill. So I'm just saying right across the Caribbean region, English, Dutch speaking, Spanish speaking, we see tremendous opportunities in private credit and the alternative investment asset class. And SCI, as a pioneer in this space, is looking to really scale the business. We really want to come back here in 3 years and talking about a 500 million or so balance sheet type of business, right? That's what we are pushing for. And that is what is guiding our strategy. Of course, there may be bumps along the way. One of the bumps that we have had, of course, is, last year we had to take a charge off, but as you can see, it didn't really stop us from now reporting record net income and record net profit and increase in earnings per share. So that's the end of my presentation. I'll now take questions.
Hey, thanks for that thorough walkthrough, Jason. So we got a lot of questions. So I'll start off with a few. The first one is from Ryan Thelwell. How are you planning to finance the buyback over the projected 3 years?
Good question. Obviously, we are generating a decent amount of profit at the moment. And we also are working on a number of different financing facilities. So it will be a combination of, cash flow that we generate from our ever expanding business, as well as probably the use of some debt.
Okay, thanks for that. My additional question is, SCI's GMD liability exceeds its GMD assets during the Q2 period. Is there any cause for concern here?
So our liabilities, GMD liabilities exceed our GMD what?
Assets.
Yeah.
Right.
So in actuality, that's what we want to do, right? So that's a deliberate strategy. So if you think about it, if our Jamaican dollar liabilities are exceeding our Jamaican dollar assets, it means that we have more US dollar assets that are on the balance sheet that are being. Is that good? Well, if I'm financing using Jamaican dollars and I'm taking that money and investing in a US dollar asset and earning USD, I'll take that.
Hello, Jason.
Hello, I think I lost you guys for a moment.
Yeah, yesterday, Jason. We're hearing you loud and clear now.
I think you asked a question about Jamaican dollar liabilities versus Jamaican dollar assets. And I was saying that that's a deliberate strategy, because what we are effectively doing is using Jamaican, that we are basically raising capital in Jamaican dollars, right? And then taking, and if we take that liability and fund a USD asset, then I'm effectively hedging. I'm basically hedged, right? Because I don't want to be in a situation where I'm exposed if the exchange rate were to rapidly depreciate for whatever reason. So that is actually a deliberate strategy, and that is what most Jamaican companies do anyway. You borrow in Jamaican dollars. It's pretty cheap to borrow in Jamaican dollars and use that to invest in US dollar assets. That's what you actually want to do. So that's a deliberate strategy. And so there's no cause for concern, because ultimately, unless the currency appreciate 20% or 10% on me, I'm not really bothered about that, really.
Thanks for that explanation, Jason. So further questions we received were pertaining to in previous earnings calls and in this one, there are discussion about revolving credit line facility that SCI will have access to draw down on. Could you provide any further updates? I know you did it in the call, but just in case for anybody who joined after.
Yeah, sure. So we're always working on revolving credit facilities, which are those facilities with our major banking partners in Jamaica. We are currently working on one for them to expand the facility. So I think their facility is being increased, I think, if memory serves me right, by between 50 and 75%. But it's not large, right? It's not like a big facility. Our net total of revolving credit facilities in Jamaica is under 10 million US, which, if you ask me, is just ridiculous for a company with $150 million balance sheet, right? In Puerto Rico, that business have a revolving facility 10 times, well, 5 times what SCI has. And SCI's balance sheet is bigger than it. But for some reason, the Jamaican, for some reason, we are the facilities that we are being offered in Jamaica by our Jamaican banking partners, and we love them to death. It's pretty as a drop in the bucket. So yeah, we have them, and that's one of the reasons why, to diversify our source of funding, we are looking at external credit facilities. No, these are not revolving facilities. They are just credit facilities structured in a different way, right? And these facilities, let's say I raise $10 at the outset in one of these facilities, and we prove ourselves by paying back the facility, then the facility can expand to $20, right? And then the next time we can expand to 30. And that's how it works, because in international financial markets, and if you look at any large, properly run private credit company, that's how they operate. The banks gives them very large revolving credit facilities. For example, the credit facility will be for 3 years. And obviously what you have to do is you have to pay it out on each anniversary, and each 1 year anniversary, but it's for 3 years and it's revolving, right? And at the end of the 3 years, once you have done well and you don't have any risk in the company, then they increase the facility and expand it. That's what we are trying to do with our local banking partners, but we're not there yet. And part of this obviously is probably due to scale. I can use that excuse and say perhaps it's due to scale. We probably need to be 300 million before we access much larger facilities from our local financing partners. But at the moment, we are negotiating with external partners for substantially larger credit facilities that may not necessarily be revolving. And we will continue to work with our banking partners to try and get substantially larger revolving facilities locally. But for some reason, it's just a dynamics of the market in Puerto Rico. Revolving facilities are a dime a dozen for private credit companies in those markets who are way, way smaller than SCI. But that's a different market, right? But in Jamaica, it is what it is.
Thanks for that, Jason. So, another question that came in was pertaining to the additional income streams that would have been mentioned. Could you provide any update on these?
So all I will say is that SCI, right now, primary income stream is obviously net interest income, which is buttressed by the flow through of the value that comes from Accrescent, which primarily, again, is going to be, their value is really net interest income. So any value coming through to us is additional profit that they are making from net interest income. Obviously, the part of their business is also to sell off assets and generate upfront gain and sale of assets, right? So in our case, we have a few different what I would call financing programs that we have piloted over maybe the last 2.5 years or so. And what we are doing is expanding these programs. And we need this 100 million and above that we are trying to raise is to finance the substantial expansion of these lines of business, so to speak, which will start to show up as material lines of business in the income statement that we'll have to strip out. I don't want to say anything more than that, until when it's actually in the financial statements and I can explain it. I don't like to kind of put the cart before the horse, so to speak. So just be assured that if I say to you that we're coming with new revenue streams are coming, because everything that we have told shareholders in the past, we have delivered. So we should have a new revenue stream that is not classified as or expansion of income stream that is not classified as net interest income, which at the moment is our primary source of revenue.
Thanks for that. So a question on the operating expense side, there were increases on the management fees and corporate fees during the period. Should we expect the level of increase on a go-forward basis, given the results for the 6 months?
So good question. Happy that was brought up. So the way you need to think about SCI, right? Management fees and corporate service fees, they are charged as a percent of the assets under management. So if the assets under management jumps materially, those fees are gonna go up because they're a percentage of the assets under management. And that's the reason why I show the efficiency ratio and the management expense ratio. So if you want to evaluate the percentage change in those two fees, what you should really be looking at is, okay, are these guys efficiency ratio or the management expense ratio going out of whack? So as long as those two ratios aren't going out of whack, the management fee and the corporate service fee, it's basically quote unquote irrelevant in the grand scheme of things because it's matching pound for pound for your increase in assets under management. The assets under management can't increase if, for example, we are generating pure losses and not making profit, or if we are 50% of the portfolio is taking a charge off, and therefore the total assets obviously will go down, right? So that's the way to look at that. So to answer the question, these fees are absolutely going to go up because if we are looking to originate 300 million within the next 3 years, then that means our balance sheet will be substantially larger than it is today. So those fees will be substantially larger than they are today as well. But then the company should be making substantially more core revenues and substantially more net profit and paying out substantially more dividends and generating substantially more earnings per share. And that's the reason why the efficiency ratio and the operating and the management expense ratio are the two key things, because the management expense ratio and the management fee and the corporate service fee are captured in those two ratios.
Thank you for that, Jason. A question was asked pertaining to the diluted earnings per stock related to the impact of the convertible preference shares. Can some additional clarity be provided pertaining to that?
Right, so it's just based on the accounting rules, right? I mean, you have to report your basic earnings per share, and if you have any preference shares that could possibly be converted, then you obviously have to do the calculation and report it as that. Now, as to when you get to the period for whether or not those shareholders will want to convert, that will be dependent upon, okay, what is the stock price doing at that time? Is the company delivering on its strategy, and are shareholders confident and want to convert or not convert, right? And so the diluted earnings per share just showing you the impact if 100% of the pref shares were converted, I guess at book value as at the financial reporting date. So you can see that the dilutive effect is 0.0 is what, 0.1 US cents, which is not material in the grand scheme of things. But that is what that calculation is reflecting. And if we raise additional pref share, we will have to show that additional calculation. It doesn't mean that the pref share will absolutely be converted. It's just saying, well, if they are converted, what would the earnings per share be? And that's what the diluted is referencing. So from our point of view, it's at the moment is not really material, and it still would not detract from the fact that year over year, earnings per share, has increased by a decent amount, whether you look at it from a dilutive earnings per share perspective or the basic earnings per share perspective.
All right, thanks for that, Jason. So a question that came in is pertaining to how exactly will the Puerto Rico Credit Fund allow SCI to grow exponentially? It is believed that they have a large number of small-scale private credit investment, but how does the private Puerto Rico Credit Fund give access where SCI didn't have before?
Okay, phenomenal question, right? Because these are the questions I actually want to delve into and answer. So let's step back for a moment. So Puerto Rico is a $100 billion economy. I just said that the gross national product is about 70 billion, right? And they have 50 billion in earmarked spending over the next 5 years. Okay. So Puerto Rico has two business lines, right? It has a lease financing business and it have a business just like what SCI do. The lease financing business is basically an autopilot thing. So if you think about Puerto Rico, it is the United States of America largest pharmaceutical industry. So the territory that has the largest pharmaceutical exposure in terms of development and activity and company headquarters, etc., is in Puerto Rico. So the Puerto Rico business gives us access to investment opportunities that we simply don't have in the English and the speaking Caribbean. So you're talking about technology firms, healthcare sector, certain parts of the construction industry. For example, they have a robust business in Puerto Rico where people are doing retrofitting of apartments, etc., on a daily basis. Why? Because Puerto Rico has not really built any new apartments in the last dozen years, which is not like Jamaica. So you literally have the government of the United States giving the Puerto Rican authorities the ability to say, okay, if you retrofit this building, I will pay for people to come and live in the building. All you have to do is do the retrofitting and I will pay you. You have tax credits that you can utilize. The government provide tax credits for you to actually go and do this activity. You have the building of new facilities that the government will actually pay for the persons who are going to live in those buildings. You have financing earmark for, okay, they come and check the roof of your house and it's leaking, they retrofit it and they pay you. So that leg of the construction industry, we don't have that exposure. We don't have that ability to do that on any grand scale in Jamaica. We don't have any ability to do leasing to pharmaceutical companies or to other companies on a grand scale in Jamaica. The quality of the portfolio companies in Puerto Rico, because it's effectively going to become an investment grade country asset, very soon. Once they get over this little hump of spending some of the money that is earmarked and rebuild the economy, etc., it's gonna become investment grade at some point, right? It has this big brother, the US, right over the corner. So the scale of opportunities in Puerto Rico, let's narrow it down to say a 70 billion gross national product economy, means that in Puerto Rico, those guys can underwrite or deploy 30, 40, $50 million in a single transaction like this because their economy is extremely large. We can't, those type of size transactions in our neck of the woods, they may occur, but they are going to occur way less frequently because the size of the businesses in Jamaica and the Dutch Caribbean and Bahamas and Barbados simply aren't going to be of that nature. And so because of the size of the economy and the size of the opportunities in Puerto Rico, where you can fund a transaction for 18, 20 million one time, in other words, you only look at your pipeline and your pipeline is 200 million, 300 million, there are going to be multiple $20 million transactions in that pipeline, which you can fund, which in our neck of the woods, in the Caribbean, English and the speaking Caribbean, we may only have two or three of those transactions. And so the ability to scale Puerto Rico at 2 or 3 times what we are doing in English and the speaking Caribbean is a real opportunity. Once we lock down the financing, we can actually do that. In Puerto Rico as well, they have a well-established impact investing platform, right? Which they are investing for environmental, social, and governance issues. And they are investors who already are used to impact investing in Puerto Rico and utilizing Accrescent Financial Corporation as their investment partner. Accrescent Financial Corporation actually has about 3 different impact investing vehicles, right? They just raised a lot of capital from some of the largest impact investing investors in the United States. And that capital is being deployed or needs to be deployed very fast. So by having that combination of a different strategy of how to deploy private credit investment opportunities, having a scale of an economy where to find $300 million in originations, it's much easier to do because the scale of the companies in that market are way bigger than the scale of the companies that we have in the Caribbean region. That ability to deploy capital in that category within such a bigger economy means that the Puerto Rico business should grow much, much faster than the English and the speaking Caribbean business. And so once we complete the integration and get that engine humming the way we want it to hum, it will absolutely, or it should absolutely dwarf what we are doing in the English and the speaking Caribbean. So that's how I would answer the question. I hope I answered it. I answered the pain points that you were looking for.
Yeah, man, that's a very thorough explanation. Thanks for that, Jason. So, additional question that came in was pertaining to, given the, can you give an example of the level of debt SCI expects to have? The level of debt SCI expects to have once the negotiations with the international financing partners have been completed.
So the way I would answer this question is that the way that these facilities will be structured, SCI's level of debt per se won't necessarily be increasing, because the way we're going to structure the facility, it won't really show up as debt on SCI's balance sheet. That's the best way I can explain it. So it's not a situation of SCI going out and just taking $100 million in debt and putting it on its balance sheet. It's going to be structured very differently. So SCI will have access to financing to utilize to grow and expand. But you won't necessarily see, obviously we can't take $100 million in debt and put on SCI's balance sheet, right? Because we would breach the threshold limits that we want to utilize in terms of SCI not being an overly leveraged company. Like banks are leveraged up 10 times, but banks take deposits, right? So once they have a good deposit base, that's not a problem. We are not a bank, we don't take deposits, we don't do banking activities, and so we ensure that our leverage ratios are much, much lower, which means that when you get into crisis periods, which is where private credit financing firms need to actually be agile and nimble and to be deploying capital and financing, we don't really have a balance sheet problem, because we are not like over leveraged and then have to be worrying about, oh, I have so much debt, I can't finance any more investment. No. So to answer the question specifically, those credit facilities won't really show up on SCI balance sheet as debt.
Thanks for that. So a question came in pertaining to Puerto Rico. Things seem to be going great in Puerto Rico. In your risk assessment of the country, did you identify any potential downside risk? And if yes, what mitigating strategies has SCI put in place?
Good question. So, I mean, the answer is yes, obviously. We did an entire thorough, in my previous life, I was an economist, or a so-called economist for a number of years. So we absolutely assessed the Puerto Rican economy. And the beauty about Puerto Rico is that if you're looking at economic life cycles, Puerto Rico was at the absolute bottom of its life cycle when we entered. Meaning they were actually, when we started negotiating to acquire Acquisent for SCI, Puerto Rico was still in default. And that would have been in default for like 14 years or more than a dozen years. You can't get worse than that, right? We are in default with the creditors. And they would have been hit by natural disasters, etc. And they would have not done any rebuilding in more than a decade, which is why now the construction industry in Puerto Rico is absolutely roaring, right? So we looked at it, and the downside, obviously, the big risk obviously would be if they get hit by a natural disaster, which is a risk that exists everywhere. Jamaica has that risk. All the Caribbean has that risk. You can get hit by a hurricane, big hurricane, or you can get hit by a big earthquake. So that risk is not exclusive to Puerto Rico. It's entire Caribbean that we invest in. And so from that perspective, we don't see any big downside risk that is different from what our general than our appetite for risk is. The beauty though is that on the downside, Puerto Rico has the US. It's a US territory. And so from a mitigating perspective, anything that happens to Puerto Rico, it has a big brother that it will be able to call on, which it actually did, and which is actually benefiting from now. Yes, it took some time and it took some years, but the fact of the matter is they have $50 billion to spend for the next 5 years. And if they were to get hit again, I suspect that they would actually have more money earmarked, and that the channel through which this money would flow would actually increase. So that's the beauty of having a Caribbean country, which is a US territory, because it has a big brother that actually can assist. Yes, the assistance for the country, for the people who are running the country, such as the governor, etc., will come with certain conditions. But the fact is, they have a big brother that they can call. So that's a good thing. But I think that in general, where Puerto Rico is now, and what we look on in terms of downside, we think that the economy is pretty much insulated, at least for the next 5 years, just because of the dynamics. People were actually leaving Puerto Rico to go to US mainland. Now people are kind of starting to return. Puerto Rico has a massive tax incentive for US residents. And so that's also another downside protection, because investment is flowing into Puerto Rico like never before. Why? Because now that they have come out of default, it means that people can actually activate the tax benefits that actually existed there before. They couldn't activate it before because the country was in default, and therefore you really basically couldn't do anything. Nobody is not going to do business with a country that's in default, right? Now that it's come out of default, what we see happening, being on the ground, is that we see people activating all of those benefits. And so there are multiple channels of downside protection. You have the tax credit, which is a benefit that US residents and US citizens are trying to take advantage of by flowing capital into Puerto Rico. You have the downside protection of the fact that the US government is providing support to Puerto Rico. And you have the downside protection in that Puerto Rico is just coming out of a very bad economic backdrop, which means the risk of them falling back into that trap in the very near term is pretty remote, although it can happen due to natural disasters. But this is not mutually exclusive to Puerto Rico. It can happen to any Caribbean territory. And so it's very good that we actually diversified and have this significant investment in Puerto Rico as a diversification tool, and not just in terms of saying you have the cash diversified Puerto Rico, which has its own capital raising efforts from the Puerto Rican market to raise capital and do its own business, and then channel that back through to SCI at some point in terms of forms of dividend payout whenever that starts, etc. But also by the quality of the assets that the Puerto Rico business is giving us. When Puerto Rico enter into a lease with a pharmaceutical company, for example, that lease is a solid investment. Puerto Rico's net charge-off in 19 years of business or thereabouts is 0.1%. I want you to think about that. They have deployed over, I think, 500 million in capital over that time, and they have only charged off 0.1%. That is phenomenal. So we basically have a business operating an economy that has seen basically more than 10 years worth of economic crisis, and it has only lost 0.1% of that money in all of that years of operation rating. So this business is a phenomenal business, right? We just need to figure out a way how to just scale it every single year for the next 3 years by a very big margin. And we have already started that process. As you know, with any new business, you go in, you assess, then it's gonna take a little while for you to ramp up, but they have had phenomenal performance. And so we think that there are multiple channels of downside protection from the economic perspective and from the business itself, because the business has been operating in the economic environment for almost 2 decades.
Thanks for that, Jason. That's very, very thorough. So I have one more, I said 2 more questions that came in. One is saying, well, it said very good presentation. They said also asking, are you able to state how many exit SCI has done so far? I'm not sure if it's over the life. They didn't say if it's over the life of SCI or just for the quarter.
Well, we did 3 during the quarter. We exited 2 hospitality investments, and I don't remember what the third one was. So we did 3. I think the value of those 3 was 1 million for the hospitality. I don't quite recall what it was, but I know that it's between 1 and 3 million that would have exited during the December quarter. But over the life, I think I presented on this at an AGM before. I didn't do it this AGM, but maybe 2022 AGM, I would have said that would have exited maybe $40 million of exit, or north of $40 million of exits at that time, which obviously would have increased to this period, which would have represented 1 full life cycle of capital being deployed and getting back all of your money. So I don't have the figure in my head right now, but we have exited maybe what, 20 25 or so, more than 2 dozen portfolio investments would have done. And certainly I'm pretty sure that the figure is way north of 40 million. I can't tell you exactly at the moment, but we have had 1 cycle of what you call portfolio seasoning, which means we deploy out all our money and we get back all our money from that initial full set of deployment, and we basically then redeploy that capital again, because our average life is less than 2 years, and so we would have, I think we probably almost in the second would have almost gone far in the second life cycle of getting repayments. But I can perhaps pull that figure and answer it on the next call. But I know that we have exited a substantial amount of investment, getting back our capital.
All right. So the last question I see here is, are there any plans to enter Guyana?
People are always asking me on the side about Guyana. So we are looking at all opportunities. I think we have 1 investment in our pipeline, which is from a Guyana origin. We're absolutely looking at all options, obviously. So what I would say at this moment, we are not aggressively pushing into Guyana. I mean, the securities laws in Guyana kind of need, we need to understand that a bit more. How the contract law is being upheld, the legal system, all of these are, necessary prerequisites for us to go into a jurisdiction, because ultimately the ultimate protection is, okay, when I go to court with my piece of with my documentation, will the laws protect me or not, kind of thing. So we are assessing that, and we will assess it further, obviously, with these opportunities that we are looking at before we make it, if we make it. So once we are very comfortable around that, as well as just the banking system, once we are comfortable around just the financial sector and the laws of the land, I'm sure that we will jump in and be aggressive. But at the moment, we are not really aggressive. What we are trying to do is we have a pipeline in the English and the speaking Caribbean that is way north of 100 million, and we are trying to lock, and we are mandated for probably about 100 million, and we're trying to, as fast as possible, lock in the capital that is required to actually execute those transactions. That's what we are gung-ho on at the moment, and later on in this calendar year, we will try and see how we can push. If we get the first transaction in Guyana through the door, that will give us the necessary knowledge around how Guyana legal framework and financial infrastructure and architecture works, and then we will obviously look for opportunities and push hard. But for the moment, we're not really pushing hard, but we do have an opportunity that we're looking at.
Okay, so that would round out all of our questions this morning. Thank you, Jason, for making yourself available for our Q2 earnings call. Thank you for everyone that joined us today. The recording of this earnings call will be on our YouTube page as well as on the SYGNUS website. And as Jason would have mentioned earlier, we encourage everybody to read and listen to this earnings call along with the MD&A that would have been sent to the Jamaica Stock Exchange as well as the SYGNUSgroup.com. So thank you, everyone, and have a good day.
All right, thank you.